Welcome back, friends, to Boss Economics World, the only show that cuts through the $5 words and $10 trillion bailouts to tell you what's really happening to your money. It's October 6, 2025. The autumn leaves are falling, pumpkin spice is back in everything, and the wizards of monetary policy at the Federal Reserve are preparing their next magic trick, making interest rates disappear. A fresh memo from the data prophets at Bloomberg Economics just landed on my desk, and folks, it's a doozy. It paints a picture of a world so fractured, so divided on economic policy, it makes a family Thanksgiving dinner with political arguments look like a group hug. The headline? The Fed and its buddies across the emerging markets are on a rate-cutting binge. 15 major central banks, from Washington to Brasilia, are sharpening their knives to slash borrowing costs. But wait. Over in old Europe? Frankfurt, London, Stockholm? They've slammed the brakes. They're standing on the sidelines, hands in their pockets, pretending to be very interested in the strength of inflation, which is central bankers speak for. We have absolutely no clue what to do next. And then, a plot twist worthy of a Hollywood blockbuster. The Bank of Japan, the institution that literally invented a 30-year coma as a form of economic policy, has woken up. They're not cutting. They're not holding. They're hiking. So what in the name of John Maynard Keynes is going on? We're told this is a tale of economic resilience and lingering inflation. But that's the press release version. Here, we don't do press releases. We do autopsies. So grab your coffee, strap in, and let's dissect the three-ring circus that is the 2025 global economy. This isn't just a story about numbers, it's a story about the end of an era. Let's start at home, in the good old US of A. The Fed is set to cut rates not once, but twice more before we ring in 2026. Then, they'll keep snipping away quarterly. On the surface, this sounds great, right? Cheaper mortgages, easier business loans, stonks go up. The party's back on. Not so fast. This isn't the triumphant bugle call of a conquering economy. This is the nervous, shaky music you hear in a horror movie right before the monster jumps out. The Fed is cutting rates because the US economy, after the sugar high of the post-pandemic stimulus and the brief, glorious return of normalcy, is now running on fumes. Let's look at the real data, not the cherry-picked numbers they feed you. Q3 GDP growth for 2025 is projected to come in at a sluggish 1.2% annualized. That's not a recession, but it's what pilots call stall speed. We're gliding, not flying. The labor market? The headline unemployment number is still a respectable 4.2%, but peel back one layer of that onion and you'll cry. The U6 rate, which includes the underemployed and discouraged workers, has crept up to 8.5%. Job creation is almost exclusively in part-time, low-wage service sectors and gig work. A recent survey from the Bureau of Labor Statistics showed that the number of Americans holding multiple jobs to make ends meet is at a 30-year high. This isn't a strong economy, it's a tired economy, a desperate economy. So, the Fed has to cut. They have to inject some cheap money adrenaline into the system to stop the glide from turning into a nosedive. But here's the paradox. The monster in the closet, the reason they're cutting with all the speed and confidence of a teenager learning to drive a stick shift, has a name: Trumpflation. President Trump's second term has been defined by a relentless, scattergun approach to trade. The tariff of the month club is in full swing. One day it's a 20% tariff on German cars, the next it's 15% on Vietnamese textiles. This isn't just a headache for importers, it's a structural drip of inflation directly into the veins of the American consumer. Every tariff is a tax, and you, the consumer, are paying it. This is why core inflation, especially for goods, remains stubbornly sticky at around 3.3%. We beat the post-pandemic supply chain inflation, but we've replaced it with a man-made, politically driven inflation that the Fed has zero control over. So Jerome Powell is trapped. He's staring at a slowing economy that needs lower rates, but every time he reaches for the cut button, he sees the ghost of Trump's tariffs pushing inflation back up. He's trying to put out a fire in the living room while the president is squirting gasoline on it from the rose garden. The result? These aren't bold, decisive cuts. They're timid, quarter-point, please don't spook the market cuts. And the terminal rate, the place where they expect rates to finally settle, is now projected to be around 3.25%, a full point higher than the pre-pandemic norm. The era of free money is dead and buried. This is the new reality, a world where capital has a cost, even when the economy is weak. Now let's hop across the Atlantic, where the mood isn't nervous, it's funereal. The European Central Bank and the Bank of England are on hold. Why? Because they are staring down the barrel of the most feared word in economics, stagflation. Europe has the worst of all worlds. They have America's inflation problem without America's economic dynamism. Eurozone GDP growth for 2025 is forecast to be a pathetic 0.4%. Germany, the so-called industrial engine of the continent, is in a de facto recession, with its manufacturing PMI languishing below 45 for 18 straight months. The culprit? Decades of reliance on cheap Russian gas, which has gone forever, and a manufacturing model built for a globalized world that no longer exists. They built the world's best horse-drawn carriage just as the automobile was invented. Meanwhile, Eurozone inflation is stuck at 3.5%, driven by volatile energy prices and a tight services labor market. So ECB President Christine Lagarde is paralyzed. If she cuts rates to help the moribund economy, she risks inflation spiraling back towards the crisis levels of 2022. If she holds or, God forbid, hikes, she will personally shove the entire continent off an economic cliff. So she does nothing. She pauses. She gauges. She monitors. She uses a thesaurus of inaction while the real economy for millions of Europeans grinds to a halt. The situation is even more grim in the UK. They have the global inflation and energy problems, plus a special, homebrewed misery called the Brexit dividend, which turned out to be a permanent 5 to 10% hit to their GDP potential and a chronic labor shortage in key sectors. The Bank of England is on hold because, like the ECB, any move they make is the wrong one. This isn't resilience. This is purgatory. It's a policy trap from which there is no easy escape. Europe is the cautionary tale of what happens when geopolitical shocks and long-term structural decay collide. And now for the weirdest part of our story. Japan. For 30 years, Japan has been the world's economic laboratory for deflation. They tried everything to create inflation: zero interest rates, negative interest rates, quantitative easing so massive they practically own the entire Japanese stock market. Nothing worked. Deflation was a zombie they just couldn't kill. Until now. The Bank of Japan is hiking rates. This is the economic equivalent of seeing a pig fly. What happened? Two things. First, the rest of the world's inflation finally washed ashore. A dramatically weakened yen, a side effect of the Fed's aggressive hiking cycle in 2022 to 2024, made everything Japan imports astronomically expensive. Energy, food, raw materials, all on fire. Second, and this is the crucial part, it finally forced a change in the Japanese mindset. For the first time in a generation, major corporations like Toyota and Hitachi, under immense pressure, agreed to significant, multi-year wage increases. The legendary Shinto spring wage negotiations of 2024 and 2025 were landmark events. The wage price spiral, a terrifying monster for the West, was the beautiful princess Japan had been trying to awaken for 30 years. Well, they kissed her, and she woke up as Godzilla. Inflation in Tokyo is now running at 3.1%, and with wages finally rising, the BOJ has a terrifying new problem: controlling the very inflation they spent 3 decades trying to create. Their first hike from negative territory was a seismic shock. Their next one will be even bigger. The problem is, the entire Japanese financial system and a good chunk of the global system is built on the foundation of a zero-rate, weak yen Japan. Japanese pension funds are the largest foreign holders of US treasuries. What happens when it's suddenly more attractive for them to bring that money home and invest in a Japanese government bond that actually pays them something? It creates a doom loop. A stronger yen makes Japanese exports more expensive, potentially hurting the economy. Higher rates could blow up a government that has a debt-to-GDP ratio of over 260%. The BOJ is walking on a tightrope made of razor wire over a pit of fire. Their grand experiment is finally over, and the cleanup could be messy for all of us. So we have 3 major economic blocks heading in 3 completely different directions. This isn't just a collection of disconnected policy decisions. This is the symptom of a much deeper disease. This is the final nail in the coffin of globalization 1.0. 1. The great unraveling, the synchronized, globalized world we've known for 40 years is over. We are now in an era of economic balkanization. The US is an inflationary island of protectionism. Europe is a stagflationary museum of its former industrial glory. And Asia is a chaotic mix of a rising rate Japan and a China still grappling with its demographic and real estate collapse. You can no longer just buy a global index fund and assume everyone rises together. The currency wars are back, and they will be brutal. The dollar, yen, and euro are on a collision course. 2. The zombie apocalypse is here. Years of free money didn't create a vibrant economy. It created a legion of zombie companies, businesses that were not profitable but could survive by constantly refinancing cheap debt. The rate hikes of 2023 to 2024 were the shotgun blast that took many of them down. But many more are still stumbling around. The commercial real estate sector is a ghost town. Private equity firms are sitting on trillions in assets they can't sell. Even with the Fed cutting, the new, higher cost of capital means the reckoning is not over. It's just been postponed. 3. The war on the middle class. Look at this picture and tell me who wins. In the US, your wages are being eaten by tariff-driven inflation while the Fed's slow cuts are designed to keep you from losing your job, but not to make you richer. In Europe, you face stagnant wages, high inflation, and the constant threat of recession. In Japan, your savings are being inflated away for the first time in your life. This is the brutal truth: modern monetary policy is no longer a tool for broad prosperity. It's a desperate triage effort to prevent total systemic collapse, and the patient on the operating table is the global financial system, not you. The average person is just the collateral damage. Whether they hike, hold, or cut, your purchasing power is what gets sacrificed at the altar of financial stability. The investor's playbook for the Great Divergence. So, how do you navigate this mess? Forget the old rules. Volatility is your new best friend. The divergence means massive swings in currencies and asset classes. The complacent, by the dip mentality of the 2010s will get you slaughtered. Cash is not trash, it's a weapon. In a world where the terminal rate is higher, cash actually gives you a decent, risk-free return. It provides the optionality to buy when there's blood in the streets, and believe me, there will be. Think regionally, not globally. Where is there actual growth? Where are the structural tailwinds? Maybe it's specific sectors in India, or robotics in a reshoring-focused America, or healthcare in aging societies. The one-size-fits-all global approach is dead. The story for the rest of 2025 and into 2026 is one of divergence, desperation, and debt. The central bankers are no longer the omnipotent masters of the universe they pretended to be. They are firefighters in a burning building, each trying to save their own room, not realizing the entire foundation is rotten. They will tell you about their data-dependent approach and their hopes for a soft landing. Don't buy it. They are flying blind in a hurricane of their own making, fueled by decades of easy money and the harsh new realities of a fractured world. So keep your head on a swivel. Question the narrative. And remember that in this new era, the biggest risk isn't being out of the market, it's believing the people who broke it know how to fix it. This is Boss Economics World. Stay cynical.